This coming week was due to see the latest Davos World Economic Forum, but the annual get-together of the great and the good in Switzerland has been postponed until the summer, owing to the pandemic. I'm sure that a few hoteliers, restaurateurs and private jet operators are distraught, but whether you think this is a big loss and a shame is something that only you can decide for yourself. In the absence of the Davos Jamboree, investors who like to look at the big macroeconomic picture may home in on the latest unemployment and wage growth numbers from the UK on the 18th of January, and then Britain's inflation update on the 19th. But one announcement which might not get as much attention as it should could just be the latest monetary policy decision from the Bank of Japan on Tuesday the 18th of January. You can be forgiven for thinking, well, what's the big deal? After all, the BOJ has held its headline interest rate at minus 0.1% since February 2016, and the last time the key borrowing rate stood above 1% was 1995. In that context, no one's expecting Governor Haruhiko Kuroda to raise interest rates, even if the Bank of England finally got round to it in 2021, and the US Federal Reserve has threatened to move on perhaps 3 occasions in 2022. No, what catches the eye in Japan is how the central bank stopped adding to quantitative easing, or QE, in May 2021. Its balance sheet has not grown since then, even if official policy is still to buy assets, government bonds, corporate bonds, equity exchange-traded funds and real estate investment trusts, to the tune of 180 billion yen a year. That's the equivalent of 1.6 trillion US dollars or 1.1 trillion pounds. And the Bank of England has only authorised £895 billion worth of QE in total since 2009, let alone each year. In many ways, Japan is therefore the poster child for proponents of ultra-loose, unorthodox monetary policy. Except, again, the BOJ's balance sheet stopped growing. So, keep an eye out for any comments on QE and asset purchase programmes, because the tide does seem to be turning toward tighter policy, or at least policy that's less loose even in Japan, as that same tide begins to move around the world. On the corporate front, the latest quarterly earnings season in the USA is just starting to hit top gear, and there will be bellwether results from a range of industries to scrutinise in the coming week, including Bank of America on Tuesday the 18th, Procter & Gamble on the 19th, Netflix on the 20th, and Schlumberger on Friday the 21st. Here in the UK, there's a long list of trading statements with the occasional set of interim and full-year results thrown in. Names which may be worthy of note and therefore further research include the following, although do please note that these dates are potentially subject to change. Ashmore on Monday the 17th, BHP, McBride, Hayes and Elementis on the 18th, Burberry, Antofagasta, JD Wetherspoon, WH Smith and Sentiment on the 19th, and Pearson, Entain, Premier Foods, Wix, Superdry and Ibstock on Thursday the 20th. That's also when minor BHP will host a shareholder meeting. Investors will vote on the plan to unify the company's corporate structure under the Australian parent and shift the primary quote for the stock to Sydney, leaving the UK with a standard listing that will not qualify for inclusion in the FTSE 100 index. However, the company which may be capable of causing the biggest fuss in the week ahead is another miner, Rio Tinto. The FTSE 100 member is due to release a fourth quarter trading update on the evening of Monday the 17th of January UK time, which is the morning of Tuesday the 18th down in Australia. The shares are down by nearly a fifth over the past 12 months, not helped by a one-quarter slide in the price of one of the miner's key commodities, iron ore. That's been weak due to fears of a slowdown in the Chinese property market, amid concerns of the financial health of Evergrande and a range of other developers, as well as a crackdown by the Chinese authorities on speculation in a range of assets, including real estate. However, both iron ore and Rio shares have begun to rally, perhaps in the wake of loosening Chinese monetary policy in December, perhaps in response to rising inflation worldwide, and the view that real assets might be a haven or beneficiary if that trend continues from a financial markets perspective. This update is therefore well-timed, even if it will concentrate on the operations and output by mineral. The full-year results with a complete profit and loss account, cash flow and balance sheet, as well as dividend announcement, aren't due until the 23rd of February. If you'll pardon the expression, at the third quarter stage, Chief Executive Jakob Stausholm refined guidance for several of Rio's operations, trimming expectations for iron ore shipments, bauxite and copper, while he left them unchanged for aluminium and diamonds. As a result, this table is your benchmark for full-year output for the principal commodities, based on that guidance and analysts' consensus forecasts. In sum, Rio Tinto is looking for small drops in iron ore shipments, bauxite, copper and diamonds, with no change in alumina and aluminium. Rio Tinto also usually gives guidance for output for the coming year at this stage. Again, the next table will provide you with a benchmark for 2022's forecasts, if any are given, in the form of the current analysts' consensus. In sum, copper output's expected to grow nicely, with smaller increases in bauxite and iron ore, and broadly flat output at aluminium, alumina and diamonds. Mr. Stauso may outline some strategic thoughts on the macro outlook and specific operations and projects, noted with the giant copper mine in Mongolia, but it's highly unlikely that Rio Tinto will give any comment on profits. If it does, the current analyst consensus is for earnings before interest, taxes, depreciation and amortization, or EBITDA, to reach $38.1 billion on an underlying basis, compared to $23.9 billion in 2020. For 2022, analysts looking for a sharp retreat to $27.6 billion, mainly thanks to the iron ore price drop that we saw last year. I hope that you and your families are in good health and good spirits. Thank you for watching, and I look forward to seeing you and talking to you again next week.